What if the secret to building $1 million portfolio isn't chasing hot stocks, but finding overlooked companies with unbeatable advantages? These are wide moat stocks, a term made famous by Warren Buffett, and today I'll reveal two that are trading at a discount. These titans quietly compound wealth for investors who know where to look. We'll break down what makes these stocks special, why they're undervalued, and how a small investment could grow into a life-changing sum over time. Smash that like button and let's dive in. First up is a company you've probably never heard of, but if you care about long-term wealth building, it's one you should definitely get to know. This isn't a flashy tech startup or a household name you see in the news every day. Instead, it's a quiet giant, operating behind the scenes in one of the most important industries in the world. Huntington Ingalls Industries, ticker symbol HII, is a powerhouse in an industry with sky-high barriers to entry. This is a business where only the best survive, and the stakes couldn't be higher. We're talking about national security, global stability, and the backbone of the U.S. Navy. HII builds nuclear-powered submarines and aircraft carriers for the U.S. Navy. These aren't just any ships, they're some of the most complex, technologically advanced machines ever built by humans. Each one is a floating city, packed with cutting-edge systems and designed to operate for decades in the harshest environments on Earth. You can't just start building nuclear submarines in your garage. The expertise, facilities, and government relationships required to even bid on these projects create a moat as wide as the ocean. Decades of know-how, billions in infrastructure, and a deep trust with the U.S. government make this business nearly impossible to disrupt. In fact, HII is one of only 2 companies worldwide that can build these ships, and it's the only one making U.S. Navy aircraft carriers. A near monopoly. That means when the Navy needs a new carrier, there's only one place to go. This kind of dominance is almost unheard of in any industry. Demand for HII's services isn't driven by consumer fads or economic cycles. It's driven by the unchanging need for national defense. The U.S. Navy must maintain its fleet, upgrade its technology, and stay ahead of global threats. That means a steady stream of contracts, often stretching years or even decades into the future. That's tens of billions in guaranteed revenue, locked in by long-term contracts. For investors, this provides a level of stability and predictability that's rare in the stock market. You're not betting on the next big thing, you're investing in a business with its future revenue already mapped out. It's not a speculative bet, it's an investment in critical infrastructure. Every ship built, every submarine launched, is a testament to the skill and reliability of HII's workforce. These are high-paying, skilled jobs that support entire communities and keep the nation safe. So why is it cheap? Defense stocks like HII often fall out of favor when global conflicts aren't dominating the headlines. Investors get distracted by the latest trends, and the market forgets about the steady, essential work happening in the background. But the need for a strong Navy never disappears, and the contracts keep rolling in. The U.S. is always maintaining and upgrading its fleet, and HII is the main beneficiary. Whether it's routine maintenance, major overhauls, or building the next generation of ships, HII is at the center of it all. This ongoing work ensures a steady flow of revenue regardless of what's happening in the broader economy. Let's talk numbers. HII trades at a forward PE ratio well below the S&P 500 average. That means you're paying less for each dollar of future earnings compared to most other companies in the market. It's a rare opportunity to buy a premium business at a bargain price. You're getting a premium business at a bargain price. This is the kind of setup value investors dream about: high quality, low price, and a clear path to long-term growth. Even better, HII returns cash to shareholders with a fantastic track record of dividend growth, over 17% annually for the last decade. That's not just a number, it's a sign of a business that's confident in its future and committed to rewarding its owners. That's a sign of confidence in future earnings and a healthy, shareholder-friendly business. When a company can consistently raise its dividend at that pace, it means management is doing something right. With that kind of dividend growth, your quarterly paycheck gets a big raise every year. Over time, those increases add up, turning a modest income stream into a powerful engine for wealth creation. Reinvest those dividends, and compounding works its magic. Your stake and income grow and your returns snowball. This is how small investments become large fortunes, not through luck but through patience and discipline. This is how generational wealth is built, step by step, dividend by dividend. Imagine passing down not just money but a legacy of smart investing and financial security to your children and grandchildren. The business is a fortress, with a $48 billion backlog, future revenue already on the books. That's more than the annual GDP of some small countries, and it gives HII a level of security most companies can only dream of. This massive backlog gives management long-term visibility to invest in new technology, improve efficiency, and keep rewarding shareholders. It's a virtuous cycle. Strong contracts lead to investment, which leads to even stronger performance. Some worry about HII's dependence on the US government, but here, it's a strength. The Navy and HII have a century-old partnership built on trust, reliability, and shared mission. This isn't a customer that's going away anytime soon. There's no alternative for what HII provides. If the Navy needs a new carrier or submarine, HII is the only game in town. That kind of exclusivity is almost impossible to find in today's hyper-competitive world. The government needs HII as much as HII needs the government. It's a symbiotic relationship, with both sides invested in each other's success. That's a level of stability and predictability that's hard to match. Huntington Ingalls Industries, trading under the ticker HII, is a major player in the defense sector with a market cap of $8.89 billion. The company posted strong earnings per share at $13.88 and maintains a price-to-earnings ratio of 16.29. With $11.54 billion in revenue for 2024 and a net income of $550 million, HII continues to deliver solid fundamentals. Its dividend yield currently stands at 1.77%, offering income potential to investors, and with a stock price of $226.15, about 19.89% below its fair value estimate of $271.12, there may be notable upside for value-focused investors. HII has also been active on the innovation and strategic communications front. On June 11th, the company made a strong showing at the Defense Tech Live event, spotlighting its Mission Technologies division and reinforcing its reputation as a leader in defense innovation. Just weeks earlier, on May 27th, the company hosted members of the United Kingdom's House of Commons Defense Committee at its Newport News shipbuilding facility, demonstrating its growing international engagement and influence in global defense matters. Further boosting investor confidence, HII's president and CEO is slated to participate in Bernstein's 41st Annual Strategic Decisions Conference. Scheduled for May 28, this event underscores the company's commitment to transparent leadership and strategic growth. These developments reflect a company that's not only rooted in tradition, but also pushing forward with proactive investor engagement and long-term value creation. The current valuation doesn't match the business's reality. Analysts project strong earnings growth ahead, driven by new contracts, technological upgrades, and ongoing demand for naval power. The market may be sleeping on HII, but the fundamentals are wide awake. You get a low starting valuation, strong growth, and a rapidly growing dividend, the holy trinity for long-term investing. It's rare to find all three in one company, especially in a business as essential as this. Imagine investing in HII today. You buy at a discount, collect and reinvest dividends, and watch the company execute on its massive backlog. Over time, your investment grows, your income rises, and your financial future becomes more secure. As earnings grow, the market eventually recognizes HII's true value, and the stock price climbs. It may not happen overnight, but the fundamentals are too strong to ignore forever. This isn't about doubling your money overnight. It's about owning a great business and letting it work for you over 10, 15, or 20 years. The real magic happens with time and patience. The combination of price appreciation and compounding dividends can turn a modest investment into a fortune. It's not about chasing the next hot stock, it's about building wealth the proven way. HII is a classic get-rich-slow stock, the most reliable way to build wealth. It's the tortoise, not the hare, that wins the race in the end. To recap, HII is a near monopoly in a critical industry, with a huge backlog, cheap valuation, and a fast-growing dividend. It's a rare combination of safety, growth, and income. It's boring, and that's what makes it beautiful. In a world obsessed with excitement and hype, sometimes the best investments are the ones that quietly deliver, year after year. While others chase hype, you can quietly build wealth with one of the world's most durable businesses. HII isn't just a stock, it's a foundation for your financial future, built to last for generations. Next up, let's shift gears to a wide moat gem from a completely different industry, Constellation Brands, ticker symbol STZ. This company is a powerhouse in the beverage world, and its story is a masterclass in how to build and defend a dominant position in a fiercely competitive market. You might not recognize the name Constellation Brands right away, but you've almost certainly encountered their products. They're the force behind some of the most popular beers in America, Corona, Modelo, Pacifico, and they also boast a premium wine and spirits portfolio that includes brands like Robert Mondavi and Svedka Vodka. Their reach extends from backyard barbecues to upscale restaurants, making them a staple in American social life. So, what gives Constellation its moat? It all comes down to branding. When you picture a cold Corona with a lime wedge on a sunny beach, you're not just thinking of a drink, you're experiencing decades of carefully crafted marketing, consistent quality, and cultural relevance. That image is the result of relentless brand building that's made Corona and Modelo household names. This brand equity acts as a mental shortcut for consumers. When people walk into a store or a bar, they gravitate toward names they trust. For a new competitor, breaking into this space is almost impossible. The emotional connection and trust built over years can't be replicated overnight no matter how much money is spent on advertising. Just look at Modelo's meteoric rise. It's now the best-selling beer in the United States, having overtaken Bud Light, a brand that dominated for decades. This wasn't a fluke. It's the result of smart, targeted marketing, a product that resonates with changing consumer tastes, and a deep understanding of what today's beer drinkers want. But Constellation's moat isn't just about branding. They have something even more powerful: exclusive rights to import and sell these powerhouse Mexican beer brands in the US. No other company can legally sell Corona or Modelo here. This isn't just a competitive advantage, it's a government-backed monopoly on some of the most desirable brands in the market. This legal agreement is like a fortress around their beer business. It's a government-sanctioned moat that keeps competitors at bay and ensures that Constellation remains the gatekeeper for these brands in the US market. It's rare to find such a clear structural advantage in any industry. The result? The beer business is a cash machine for Constellation. High margins, strong demand, and unwavering brand loyalty make their revenue streams incredibly predictable, even during economic downturns. When times get tough, people might cut back on big expenses, but they'll still reach for their favorite beer at the end of a long day. Think about it. People might skip a vacation or delay buying a new car, but they're unlikely to give up the small pleasures like enjoying a cold beer with friends or family. That's why STZ is considered a defensive stock. It holds up well even when the economy stumbles. And just like Huntington Ingalls, Constellation Brands is a dividend growth star. They've consistently raised their payouts year after year, rewarding shareholders with a growing stream of income. This commitment to returning capital is a hallmark of shareholder-friendly management. What's impressive is how management balances reinvesting for future growth, like expanding breweries and innovating new products, while also rewarding shareholders through dividends and share buybacks. This dual focus ensures the company keeps growing while also delivering value to investors. Despite all these strengths, STZ trades at a reasonable forward price-to-earnings ratio, especially when you consider the quality of its brands and the long runway for growth. For investors, that means you're not overpaying for excellence. You're getting a premium business at a fair price. Yet, the market often underestimates just how durable Constellation's moat is, and how much room there is for Modelo and other brands to keep growing. Many analysts focus on short-term trends and miss the bigger picture. This is a business built to last. Constellation Brands commands a market cap of $30.41 billion. In 2024, the company generated $10.21 billion in revenue, but posted a net loss of $81.4 million. The dividend yield currently stands at a solid 2.40%, offering shareholders consistent returns even amid financial turbulence. Recently, Constellation took bold steps to reshape its portfolio by completing a major sale to the wine group. This move is designed to streamline operations and pivot toward high-growth, high-margin brands, an effort that could improve long-term profitability. The company also revealed plans to redeem its 4.75% and 5.00% senior notes due in 2025 and 2026 respectively, indicating an active and disciplined approach to managing its debt load. Despite these forward-looking strategies, Constellation faces real challenges. Slowing beer sales and pressure on margins have contributed to a downward trend in stock performance. Over the last 5 years, the company's stock has declined by 8%, while the S&P 500 surged 86%, raising valid concerns about its market competitiveness. Financial metrics paint a mixed picture. With a debt-to-equity ratio of -0.41 and negative net income, the company shows signs of financial strain. However, its shareholder yield, a strong 47.68%, signals that investors are still seeing considerable value returned, despite the headwinds. Constellation Brands is in the midst of a strategic transformation, trying to reposition itself for growth after a challenging period of underperformance. While the path ahead is filled with both promise and pressure, the company's recent moves could set the stage for a stronger future, if it can effectively navigate the competitive and financial hurdles ahead. For long-term investors, this is a rare opportunity to buy into a premium beverage empire that's still expanding, with a portfolio of brands that dominate their categories and command customer loyalty. The premium beer segment is one of the fastest-growing areas in the beverage industry, and Constellation is leading the charge. As consumers trade up for quality and experience, STZ's brands are perfectly positioned to capture that demand. Their brands don't just sell, they command higher prices. That pricing power is a crucial part of their moat. It means they can pass on cost increases to consumers without losing market share, protecting their margins and ensuring steady cash flow. In an inflationary environment, that's a huge advantage. Strong brands allow Constellation to raise prices to offset rising costs, all while keeping customers loyal. This protects profitability and keeps the dividend engine running. That steady, growing cash flow is vital for funding dividend increases year after year. It's the foundation of a compounding machine that can build real wealth over time. So how does this translate into building millions? It's simple. Buy shares in a dominant company like Constellation, collect and reinvest those growing dividends, and let the power of compounding work its magic. Over decades, your investment snowballs, turning small beginnings into substantial wealth. As Constellation continues to grow its brands, expand its reach, and increase earnings, the stock price tends to follow. Long-term shareholders have been handsomely rewarded, and the future looks just as promising. Imagine owning STZ for 20 years. Every year, a new generation of consumers comes of age and discovers these iconic brands. The customer base keeps renewing itself, fueling ongoing growth. Meanwhile, the company never stands still. They're constantly innovating, whether it's launching new flavors, improving production efficiency, or rolling out creative marketing campaigns that keep their brands top of mind. Your investment, fueled by reinvested dividends and steady appreciation, can grow into a massive sum over time. The key ingredient? Patience. Letting your money work for you, year after year, is how real fortunes are built. Wide moat investing isn't about chasing the latest trend or trying to time the market. It's about buying superior businesses at fair prices and holding them for the long haul, letting their competitive advantages do the heavy lifting. When you own a company with enduring advantages, you can afford to be hands-off. Let the management team and the strength of the brands work for you, compounding your wealth quietly in the background. Constellation Brands, with its untouchable brands, legal moat, and unwavering commitment to shareholders, is a textbook example of a buy and hold stock. It's the kind of business you can own with confidence for decades. To recap, STZ owns iconic, high-margin beer brands, enjoys a legal monopoly in the U.S., leads the fastest-growing segment of the beverage market, and consistently rewards shareholders through dividends and buybacks. It's a rare combination of defensive stability and growth potential. This powerful blend of qualities makes Constellation Brands a cornerstone for any resilient, long-term portfolio. It's a stock that can weather storms and thrive in good times, giving you both peace of mind and the potential for outsized returns. This is how you build a resilient, million-dollar portfolio, by owning world-class businesses like Constellation Brands and letting time and compounding do the rest. There you have it, two wide moat companies trading at bargain prices, offering rare opportunities for investors who are looking to build lasting wealth. In today's market, finding businesses with a true competitive edge and a history of resilience is no easy feat, but when you do, it can make all the difference in your portfolio's long-term performance. Huntington Ingalls, the shipbuilder with a government-guaranteed backlog, stands as a pillar of stability in the defense sector. Their contracts stretch years into the future, providing a steady stream of revenue and a level of predictability that's hard to match in most industries. And then there's Constellation Brands, the beverage king with iconic brands that have become household names. Their portfolio includes some of the most recognized beers, wines, and spirits, giving them pricing power and customer loyalty that competitors envy. These are the types of businesses Warren Buffett used to build his fortune, focused on durability, strong cash flows, and the ability to weather economic storms. He sought out companies with wide moats, knowing that their long-term value would compound over decades. By adding companies like these to your portfolio, you're not just buying stocks, you're investing in a fortress designed to protect and grow your capital over time. These businesses can help anchor your investments, providing both peace of mind and the potential for significant returns. Now I want to hear from you. What's your favorite wide moat stock that's currently undervalued? Maybe it's a hidden gem, or a well-known giant that's flying under the radar. Drop your pick in the comments below and let's start a conversation. Your insights could help fellow investors discover new opportunities. Thanks for watching, and I'll see you in the next one. Until then, keep building your financial moat and investing for the future.